Welcome everyone to Team Wealth Building Live. This is Matt Sorensen. This is not Sat Morensen. That's another guy. This is Matt Sorensen. I'm excited to be with you today. Today we're talking about one of these strategies, the strategies that is unique and is an accelerator to building wealth, and that is business ownership. But the great news is you don't have to just start a small business. I've started many small businesses, but that's not the only way. You can buy an existing business. There are so many small businesses over there that need to be out there in the country that need to be acquired. There's people that are getting old. There's the baby boomers. There's divorce. There's death. There's disability. There's business partner disputes. There's people that just want to move on. Let's be honest. There's people that just aren't good business owners that need to sell their business. So there's a lot of opportunity to acquire existing businesses that have existing customers, existing teams, existing processes. You can go in and improve. I've always said this, and I still believe it today. And I think many of you have been a consumer out there and in America might appreciate this. For as many crappy houses out there that need to be rehabbed and flipped, there's a lot of small businesses out there, probably more than the crappy houses that need to be rehabbed and flipped to or cash flowed. Business ownership, there's ways to make money and building up businesses and selling them, and also, of course, just keeping them and cash flowing those businesses. So I'm going to get into the legal points here today, the strategies, the common techniques people use to go acquire existing small businesses. I've helped clients in over 100 business deals, either buying or selling small businesses as a business and tax lawyer. I've, of course, grown my own businesses over the years. So I have a good perspective on this and have been in the trenches on a lot of deals, had a lot of issues we've had to work through and a lot of lessons learned in the process. So what I want to do first, though, I want to break this into a few parts. One, I want to talk about the framework of this. How does this actually work big picture? I want to go through the process of the documents and the steps that you're going to take when actually acquiring an existing small business. The second thing I want to talk about is how do you negotiate price and how do you negotiate your terms? Okay, those are different things. Price, what's the price you're going to be willing to pay for this small business? And then what are also the terms that you're going to negotiate to pay that price? That might be seller finance. There might be an SBA loan. There might be some partnership provisions in there. There might be some work credit in lieu of payment. There's a lot of different ways that that can be split up. We're going to get to terms here in a moment. And then we're going to go over due diligence. We might not have time for this. I might break this into a 3-part series, quite honestly, because there's a lot to talk about here. But let's first start off with buying a small business and talk about the structural framework you need to get started. First, when you're going to buy a small business, you need to understand the process to do this. I think the most common process most people understand is buying a house. When you buy a house, right, there's a couple steps in the process. You make an offer to purchase the house and there's a contract. There might be some counter offers with the seller, but eventually you come to a contract. After that contract is done, you have due diligence phase, right? There might be a loan you're getting, an appraisal, an inspection. There's some due diligence that happens. And then you go to closing and it's funded and you're done, right? You close, the money's paid, new buyer takes over the property, seller goes on their merry way. In a business deal, it's similar but different. There are some similarities, but there's a lot of critical differences in buying a business that's different than buying a property. So when you buy a business, the first thing you're going to have is what's called an LOI or letter of intent. This is before you do a purchase agreement. The LOI is basically a preliminary agreement that says, hey, I'm interested in buying your business. And as the buyer, you present the LOI. Here's the terms and price I'm willing to pay. It's going to be contingent on my verification and due diligence. And then you go into a due diligence phase after an LOI has been completed. Okay, LOI being letter of intent, which is an actual contract and an agreement that you're agreeing to key terms, but it is subject to due diligence for the buyer. The buyer has the right to inspect everything like the financial records and various other things we'll talk about here later when we hit due diligence. But that's step one, LOI, due diligence. Then you're going to have a purchase agreement, but that purchase agreement is really the closing document. So during this process from LOI to due diligence, there will also be happening at the same time an asset purchase agreement or a stock purchase agreement. We'll go over when to use which one, but there'll be an asset purchase agreement that is entered into that is actually like the closing documents. And that is the document you're going to sign when you close on the sale of the business. And then the buyer takes over the business and the seller might be involved. We'll get into that. There's different ways you can transition the business, or they might walk away right after closing and hand over the keys, so to speak, to the small business. So that's the difference with a small business. The primary thing being is you don't actually sign the purchase agreement until you close. Unlike in a real estate contract, the first thing is the letter of intent, and then due diligence begins. All right, now let's get into what you need to think about when it comes to price. So in the process, and the first thing, like I said, is going to be this letter of intent that's going to go out to the seller. I've identified a business I want to buy. Someone's interested in selling it. I'm going to send over this letter of intent. And it kind of does look in a letter format that says who the buyer is, who you are, what you're willing to pay for the business. But let's talk about how you negotiate price. In order to properly negotiate price, you need to understand the net income or cash flow of the business. That is all you are buying when you buy a business, okay? No one wants to buy a business with millions and millions of revenue if it doesn't cash flow. You're buying the net income of the business. So we really want to focus on what is the cash flow? What is that business owner taking home at the end of the day? And there's a lot of important things to look at in the net income. And when you're thinking about purchasing a business, you need to understand accounting and how to read financials, or get someone on your team who does, because this is where all the devils are. The devil's in the details. It's in the financials. And a shady accountant or seller could overrepresent net income or cash flow, or leave out certain facts that you might want to know, of course, that don't make the business as valuable as you may think it may be. For example, I reviewed financials for a client recently buying a small business. This is in Florida. And in this business, there was net income of around 150 grand a year. Now I was like, why are you so excited about buying this small business? It's 150 grand net income a year. I get it. But then I looked at the payroll. And they had a couple of employees that worked at the business. This is like kind of a storefront type business, a franchise model actually. And there's 90K in payroll. How is there 90K? Is the business owner working in this business every day? Like, how is this business actually operating? It has an actual storefront and sees customers 8 a.m. to 8 p.m. every day. Like, how does it actually operate and make money with only 90K of annual payroll? So I was very skeptical about the payroll numbers. Well, it turns out the business owner was working in the business and not paying themselves an adequate salary. And so when you're looking at particularly a very small business, something that might have net income of $100,000 or $200,000, really anything below $1 million, you really got to be focused on what is the business owner paying themselves. Because the person owning the business, if they're working every day in that business and spending 40, 50, 60 hours a week in the business, and they're not taking a salary, well, that 150K of net profit is basically the salary. If you go and buy that business and you think you're going to just take it over, well, you've just bought yourself a job that pays 150 grand a year. Okay, you didn't buy a business that has any cash flow. So we want to be careful when we're looking at the financials to determine the price, that we understand the true cash flow. There's a lot that goes into that. I could probably do a whole separate live on looking at the financials and deciphering what the true cash flow of the business is. But for now, I want to say the big thing to look at is look at the payroll of the business and the financials, and then also look at what is the salary of the business owner. We want to make sure that the business owner or any family member's salary that work in the business every day is an adequate salary. Now, a lot of small business owners, right, they might be incentivized to pay themselves less money, right? Like, well, I don't want to take a salary. I'll just take profit out and I won't pay self-employment tax on it. It might be a great tax strategy. Okay. But we really want to look at what is the true salary and cost to operate that business. Now, some people buying businesses are like, I'm going to work in that business every day. That's fine. You should be. I think as you're buying a small business, you should be looking to work in that business every day to turn it around, to grow it, to be more profitable. But make sure you're just understanding the true nature of the financials. Because once you know the cash flow of the income, the adjusted EBITDA, whatever you want to call it, the actual money the seller's taking home, we're going to put a multiple on it. For small businesses, particularly very small businesses, it might be a 3x multiple. So for example, if that business has $150,000 of real cash flow, okay, real cash flow, I'm not talking about, the business owner's working in it and not taking a salary type cash flow. I'm talking about real 150K cash flow after the business owner paid themselves a salary. There's 150K left. If we take a 3x multiple on that, that business would be worth $450,000. So you might want to start there in terms of a purchase price. And the multiples go up as businesses get larger. It might be a 5x multiple if we're talking million or 10 millions of net income. And it goes up. The multiples actually are higher the larger a business is. It might be upwards of a 10x multiple, depending on sub businesses that have different characteristics. They might be recurring revenue or software or technology businesses that are easier to scale and grow larger because they don't require more employees. It's just more software. So there's a lot of factors and variables that go into what is the multiple. But for a typical small business, you're going to be in the 3 to 5x multiple here. So, all right. So I know the price I'm willing to pay. I've looked at the financials. Now you're still going to do your due diligence on this. We're just in the letter of intent phase. So let's say you're willing to pay $450,000 for the business. Then you're going to disclose the terms on which you're going to purchase the business. Now, one of the key things when purchasing a small business is make sure you are doing seller financing as a buyer. It is more common than not to have seller financing in a small business transaction. It is out of the ordinary not to have seller financing in a small business purchase. Now, that might not be 100% seller financing, but a portion of the sales price should be seller financed. There's a number of reasons why I like that. One, it requires less cash for you to purchase the business to come up with, right? Obviously, less money you have to bring to the table or less debt you have to go get from a bank or third party. Second, if you get an SBA loan, most SBA lenders like you to get at least 10% seller financing. And that seller financing comes in terms of the stack of debt and priority. If there's a default, it comes after the SBA's loan. So the SBA lenders love that. That's number two. And number three, and this is actually the most important from a business perspective, is I want that seller invested in the buyer's success. If I'm buying the business and I didn't transact all the money or give all the money to the seller, I want that seller to know, oh, if this guy bought this business for $450,000 and I seller financed 1/3 of it, he still owes me $150,000. And maybe that's over a 5-year window. I want to make sure that he pays me back this $150,000. I better make sure that he's successful in taking over this business for me. So it connects and it aligns your interest with the seller of the business. It also helps if there's been any misrepresentation in the financials or the true nature of the business, or some liability or employee issue comes up that wasn't properly disclosed. Whereas the buyer of the business, you could offset that $150K in the example I gave that you owed. So a lot of benefits to having seller financing. It's not just bringing less cash to closing. It can also help get an SBA loan, and it also connects the buyer with the seller, because the seller is going to be invested in your success because they're still going to be owed money from you as the buyer. So make sure you are doing seller financing as a purchaser. Now, I've worked on deals where 100% of the purchase price is seller financed. I've worked on deals where it might be $100,000 that's transacted in cash and the balance is on seller financing. I've had other deals where there's an SBA lender, and this is very, very common. SBA loans can go up to $10 million for acquiring businesses. But I've had transactions where there's 10% down. This is very common. 10% down from the buyer. So let's say you're buying a business for $1 million. You put 10% down of your cash, $100,000. The seller finances 10%. Then the bank, the SBA lender, funds the other 80% of the $1 million purchase price. So the bank's going to put in $800,000. And so that's a very common, that 10-10-80 split for SBA lenders. And I said 10 million, about 5 million is generally the SBA loan limits for business acquisition. If there's real property involved, you can go up to 10 million or more. But for typically just business acquisition, those are 7A loans is what they're called. And it's a $5 million limit. Now, again, the most banks like that 10-10-80. So when you're doing your LOI and you're making your offer to purchase, you need to understand these terms. You need to know, how am I going to acquire this business? Can I negotiate 100% seller financing? Can I negotiate some of my cash that I might have and the balance to be seller financing? Am I able to get an SBA loan to acquire this business? And so you need to understand those factors before you go shop, before you go make an LOI, because that's going to be, the critical section of your letter of intent and the basis on which the seller is going to decide to sell to you or not. So, so we understand price. It's a multiple of the net income. Maybe start at 3x on a buyer side, and then also make sure you understand the terms on how you're going to acquire it. Whether you're using seller financing, which I always recommend, you're using some cash that you might have coming up as the buyer of the business. You could also bring in an investor, by the way. That's very common too. You could be buying the business but not have any cash. We'll bring in an investor that brings in the cash. You could be the work partner and bring in an investor that brings in the cash necessary to acquire the property or the investment, the business. And then the seller can maybe finance the balance too. Or you could just work with an SBA lender, of course, as well, where you have the SBA lender who is putting in the bulk of the cash, 80% typically of what's needed. Seller's putting in 10% for seller financing, and then the buyer, you are putting in your own 10% down. Okay, let's talk about, let me kind of break down some deals here, and let's go to the whiteboard if we could for a second. Okay, so I've got LOI, that's letter of intent. This is number one thing you're going to be doing when you're acquiring a small business. The second thing you're going to need to do is due diligence. Okay, that's double D. That's for due diligence, though, folks. Okay, so when you're doing due diligence, there's a number of things you're going to need to request. This is going to be in the letter of intent. In the letter of intent, you're going to have the purchase price, the terms to acquire. You're also going to have a section that says, hey, and this purchase is all subject to me confirming the information you've told me about your business before I made the letter of intent. And here's the stuff I want. We want to get tax returns. We want financials of the business. We want inventory if it's a business that has inventory. We want an employee list. We want a customer list. Now, there's a lot more that you would typically request here, but let's think of these 5 things as being key. Financials. So the financials are obviously where you're going to be digging into to determine what is the net income or cash flow of the business. No one wants to buy a business that doesn't make any money, unless, of course, you think you can turn it around, and that's common too. I've worked with clients that do that. But in the financials, I'm going to really be focusing on the top line and the bottom line of revenue. I want to look at what is the total revenue of this business and what is the net profit. What is the take home that the business owner gets to take at the end of the day? That is the bottom line or net income cash flow number. Now, everything in between there, I'm going to need to verify. I want to verify all those expenses. I want to make sure that those are legitimate expenses. I want to make sure that I understand the revenue coming in as well. That's why I want a customer list. Is this business supported by one customer? Does it have 2 or 3 customers? Then if I buy that business, I'm at a huge risk. If one of the 2 of those customers leaves, the business is going to fail. So I want to know how concentrated is the customer list too. I want to know the employees, and I also want to know, are they likely to stay around? Are they family members of the business owner that are just going to peace out when the business owner sells? Are they friends of the business owner? Like, are these people that are likely to stay around? What is their compensation? I want to know that too. Is it in market? Are they below market, above market? Where are we paying them right now? And how likely are they to stay when I come in as the new business owner? And then, of course, you need to look at the inventory or other assets of the business. There's other things that might be in play here. This could be a business that's heavy on equipment, or let's say it's an auto body shop or something like that has a lot of tools and things like that that are used by the employees in the business. You might want to know. But of course, inventory and goods that you're selling are going to be critical, making sure you understand that, having an accurate count and verifiable numbers on that, because that's going into the purchase price too. All right, now tax returns. Why do I want tax returns? Well, I want tax returns because I don't believe financials. And one thing people do on their tax returns is they actually like to report less than what they make, or they definitely do not over-report their income on their tax returns. So the tax returns are a good check and balance on the financials to make sure that, they could give you a financial statement that has much higher profits than what they're actually putting on their tax return. That's a huge red flag for me. Now, there might be some legitimacy to that, right? There might be some stuff that they're writing off that they maybe shouldn't, and it's in the financials. So they're writing it off when it comes to tax time. Whatever, I get that. But it's a good check to make sure that income is not being overstated, because as a seller of a business, what is your main priority? To get the highest price possible. How do you get the highest price possible? Report the highest cash flow you can possible. Just throw it on your financials. Why not? Well, you're not going to do that on your tax returns, because that means you have to pay more in taxes. So it's a good check on the financials, a review of the tax returns of the actual business. And if this is a corporation, an S corporation or C corporation, this is on a corporate tax return, an 1120 or 1120S. If it's a sole proprietorship, just a small business, one owner, they have no entity, or maybe it's just a single member LLC, this is all going to be on Schedule C on their personal return. So you're going to see a lot of info here, and this is common that you should get this. This is something that should come out of the financials, in the negotiation process when you're in due diligence. Like, this is very common that this information is disclosed and provided to you as the buyer. All right, so we have the letter of intent. Just summarizing here, we outlined our purchase price, the terms upon which we're willing to pay. We started our due diligence, and there's usually, this could be a 60-day window, let's say, to do due diligence. It could be shorter or longer. And then we're going to have the actual agreement. And this is going to be an asset purchase agreement or a stock purchase agreement. Now, so let's do this. 1, 2, 3. Sorry for the terrible handwriting here, everyone, but you know what I'm saying. Okay. So now we're on the asset purchase agreement, stock purchase agreement. This is the more lengthy document. The letter of intent might be 3 or 4 pages. The asset purchase agreement is going to be 30, 50, 60, 100 pages. I mean, the asset purchase agreement is going to be much more lengthy and have a lot more clauses in it. Sometimes there's lawyers that do overwork these, but this is very critical. This is the paperwork upon which the purchase, hundreds of thousands, millions, tens of millions, hundreds of millions, billions of dollars in these business purchases themselves are being transacted. So the asset purchase agreement is really, really important. All right. Now, the reason I mention asset purchase agreement first instead of a stock purchase is, as a buyer of a small business, you should never do a stock purchase agreement. Let me repeat that. If you are buying a small business, do not do a stock purchase agreement. Do not buy the company or the entity, the corporation or LLC itself. Don't do that. I want you to buy the assets of the business and use an asset purchase agreement. An asset purchase agreement is a document that says, I'm going to buy the assets, but not the liabilities. So, for example, in a business, when I'm purchasing a small business, I'm purchasing the customers, the name, the goodwill, the rights to operate the company, any intellectual property it might have, all of its records, its inventory. Like, I'm buying all the assets. The entity, the LLC or corporation that currently owns it, is just what's operating that. I don't want the entity, the LLC or corporation. I just want the assets of the business. So when you purchase the assets of the business, you will start your own LLC or corporation. And we love LLCs for partnerships, S corporations if you're just individually purchasing the business. And so you're either going to typically use an LLC or an S corporation as a buyer, but you're not taking over their LLC or S corporation. You're starting fresh. Here's why. An existing business that's been around for a while might have existing liabilities. I don't want to acquire someone's LLC or corporation. I don't know what happened in 2022 in this business, what customer got pissed off in 2023, what employee might come out of the woodwork from back in 2021. I don't know that, and I don't want to deal with it. I want to start fresh with my own entity. I don't want to have any liabilities that could come back and wipe out the total value of the business. So very important, acquire that business using an asset purchase agreement, which is very common too. Most small businesses, I'd say 80, 90% are being acquired using an asset purchase agreement and not a stock purchase agreement. As you get into bigger companies in the tens or hundreds of millions of dollars, their stock purchase agreements are more common because they have more corporate structure being done. There might be more benefits and more things at the corporate level that are important to maintain. But in the small business space, if you're buying something for less than 10 million, I would just stick to an asset purchase agreement. Now, the asset purchase agreement is kind of like the closing documents in a real estate transaction, where when you get to closing, you're signing this document then. As you started with a letter of intent and moved into due diligence, frankly, everything's getting negotiated then into the asset purchase agreement. Stuff you're discovering in the due diligence that might be an issue is getting addressed in the asset purchase agreement. Now, the asset purchase agreement is going to have a couple of schedules typically. And so you might have Schedule 1 or Exhibit A, whatever you want to call it. But let's just say Schedule 1, which is going to be an attachment to the asset purchase agreement, is going to be the note. That is very common because there's generally seller financing happening, even if it's 10% or it's 100%. The seller's financing, we typically want a note, and that is attached. This is a promissory note. I would say a 5-year term is very common. It could be 10, 15, 20, doesn't matter. But I would say generally like a 5-year term is common. Okay, then let's just say 5-year. Schedule 2 is a consulting agreement. The consulting agreement is essentially a document that the seller of the business that has typically ran and operated this business is agreeing to consult with you after the purchase for a certain period of time. This might be 60 days. This might be 6 months. This could be a year. Generally, you're going to see something in 2 or 3 months, up to 6 months of time where the seller is agreeing to help transition the business. It might be to introduce you to key customers, obviously introduce you to all the employees, go over all the financials, who is the bookkeeper or accountant for the business, get into all the nitty gritty so that you as a new business owner can take over. Also, and be available to you as weird questions come up. Running a business requires a lot of different things you have to know and understand. And if you haven't faced it before, being able to call an existing business owner that sold the business that kind of knows where the bodies are buried and where the issues are and where the documents are or who person X or Y is really valuable. So we like having a consulting agreement that binds the seller and where they thereby agree to do a certain amount of effort in transitioning the business over to the new buyer. All right, let's say Schedule 3, this is another comment, is going to be the bill of sale. Okay, the bill of sale is basically like the warranty deed in a real estate transaction. The bill of sale basically says, hey, we're transitioning all these assets over to you as the buyer. And this is the personal property we own. This is the goodwill. This is anything that might be transacting. And that is happening through, again, what is called a bill of sale. And this is a one-page document. Some states have something called the bulk bill of sale and things like that. You also, as part of this process here, want to make sure that you've checked to make sure there's no liens on these assets. For example, let's say that I had a client buying a construction equipment business that would rent out like backhoes and tractors and trucks and things like that. Well, when that client purchased that business, we wanted to make sure all of those pieces of equipment didn't have liens on them. And if they did, that the purchase price being paid was going to pay off the debts on those liens, or we were going to negotiate to take over payments on those liens instead. And so you want to make sure you understand where the debt is. And when you're acquiring assets that might have liens on it, and it's usually like more of equipment type things like that, where we see that, you want to make sure that you understand what debt is coming with those, or that what portion of your purchase price is paying off those sales proceeds. Now, generally, in my law firm, KKOS Lawyers, we've escrowed business sales before. Sometimes title companies or escrow companies will do this, where basically they're working like a title and escrow company on a real estate transaction where they receive the purchase proceeds and pay off any lien holders that may be owed, and then send the rest of the proceeds to the seller of the business. So not necessary. Sometimes a lot of the lawyers involved will handle that process. That's what we've done many times on ours, particularly on the seller side. Okay, so we've got the note, the consulting agreement, the bill of sale that might be attached. Another couple of things that are included in the asset purchase agreement itself, but not in the schedules, is going to be a few important clauses. One is a non-compete. We want a non-compete agreement with the person we're buying this business from that says, you can't turn around tomorrow and just go open up the same business and then go steal all these customers I just bought from you. So you're going to agree to not compete in this industry that I just bought this business from, in this location or territory where I'm going into business, where I'm buying from you, for a period of 3 to 5 years. That's very common, and these are very enforceable. I know a lot of states like California have non-compete restrictions where non-competes are not valid in the workforce, in an employer-employee relationship. But in the essence of, or from the situation of a person buying a business from a seller, those non-competes are always going to be enforceable across all 50 states. Very hard to get out of those. But as a buyer, I want that. I don't want that seller to turn around and compete with me. They're also going to have a non-solicit agreement. The non-solicit agreement is something that says, hey, I'm buying this business from you and you agree not to come back and solicit these customers, not to solicit my employees, not to solicit the contractors or vendors that I use in the business to go off and compete with me. So the non-solicit is a little broader than a non-compete because it says you're not going to come after employees or vendors or contractors that might work in the business. So we want to have the non-solicit in the agreement as well. Okay, let me hit one other item here, and this is kind of another schedule to the asset purchase agreement. We'll call this Schedule 4, and this is the allocation of purchase price. The allocation of purchase price is important because it's going to say, all right, you're buying my business for $1 million. Of that $1 million, we're allocating $800,000 to goodwill, $100,000 to equipment, and $100,000 to inventory, let's say. Now that's important because those are all taxed differently. And this matters to both the buyer and the seller. A lot of people think, well, I don't care about it as the buyer. This is all just for the seller. How are they going to get taxed on this? Okay, let's say that was a $1 million purchase price. $800K went to goodwill. $100K went to equipment. $100K went to inventory. Okay, if I have $800,000 going to goodwill, as a seller, they get to take long-term capital gain rate, 20%. Seller loves that. Seller loves goodwill. If you're a seller of a business, you want 100% allocated to goodwill if you can get away with it. Okay, equipment. Equipment is, from a seller standpoint, did they depreciate that? Are they recapturing depreciation when they sell that? This is not good for a seller. We don't want equipment to have value as a seller because this means more tax. So as a seller, that's bad. But as a buyer, it's great. Because what are you going to do when you purchase that equipment and we can allocate a purchase price to it? We're going to depreciate that as a buyer. This is going to create expenses and depreciation costs on your end that help offset your taxable income as you're starting to make money in the business. Same thing with inventory. I don't know if the seller's written anything off or not. It's different ways they can hold their goods or their inventory. Most likely they haven't. But this is a little more tax neutral. Kind of depends on the situation. This is a little more tax neutral. So as you can see, there's a lot of nuance to this and how this happens. And a lot of these decisions of what's going on in the documents don't only matter for the closing, but it matters in the future going forward as well on what you're going to need to pay and how the taxes are going to come out. And if you're asleep at the wheel here as a buyer and allocating everything to goodwill, you're going to lose the opportunity to expense and depreciate all this equipment that you just bought in the business. Every business is going to have some equipment, whether it's some computers or something in the business. I can't think of a business that's not going to have some form of equipment. So we want to make sure we have a proper allocation to that. And that, again, is something in the asset purchase agreement. Because in your LOI and part of your due diligence, you're going to want to know this stuff. This is some of the stuff you're going to identify. What are the assets that I'm going to actually be acquiring? We want to identify those. All right. Okay, let's get into the closing process. So, okay, we had the LOI done. We got through due diligence. We learned some things there. Maybe we adjusted the purchase price or the terms. Maybe we didn't. We ended up going into an asset purchase agreement. We've negotiated that. We have all the terms. There's some seller financing with the note. We have a consulting agreement. We have the bill of sale. We've allocated the purchase price. The seller of the business knows that they can't come in and compete with us. They're going to move on and actually help us transition the business. They've agreed not to solicit our employees. They're going to release the name and everything. Now, here's where a lot of the detail gets in. Okay. At closing, of course, we're going to sign all these documents and money's going to exchange hands. If there's a bank and SBA loan in the mix, of course, they're going to be paying money as well. But what I strongly encourage for anyone purchasing a business is to create a 100-day plan. You are buying a business that is going to need immediate attention. Typically, this business has been neglected. There's a reason the seller wants to get out, or there's some outside circumstance forcing the business owner to get out. And there's likely problems in this business that are going to need to be addressed quickly. Now, I like to think of problems as opportunities for small business owners. These are ways you can increase the net income, increase the cash flow to you as the new buyer of the business. So don't be shy about problems. Those are just opportunities to improve and get more money into your pocket. But you need a plan and you need to be ready to go upon closing of the business. Now, a number of things I want you to think about at first is people. The number one thing when you're buying a small business is the people inside of it. Maybe you're buying some technology that's unique or something. Maybe you're buying some patents. Maybe you're buying some type of service at a great location that's just that location just crushes. But for the most part, the true value in the business is the people that know and understand the goods or services that are being sold. And so you have got to get in and know the people that really drive the business, and also some of the people that may have been causing problems in the business, that may be some of the reasons of why it's selling. I've definitely had that occur too, as I've had clients purchasing businesses where they come in and they realize, well, no wonder this guy wanted to sell the business. This person over here is freaking crazy and they couldn't get rid of him. All right, so first thing, think about the people, those you're going to keep and those you're going to not keep. Let's just say it that way. Let go might be the other nice way to say it. All right, the next thing is just all the legal and technical things. You're going to need a new entity, right? We didn't purchase their entity, so we need to set up our own new LLC or S corporation. You're going to need the tax ID. You're going to need to do all these things that need to happen too. You're going to need bank accounts. You don't want to take over their existing bank accounts in the business. Oh, you know what you're also going to need that could be a pain? A merchant account. Do you have a merchant account set up that can be used immediately for the business? Well, if they got a customer paying on day 2 after you bought the business, what are you going to do? Can you accept a credit card? You know, you got to be ready for that. I've had clients just think, well, I thought I would just use the seller's merchant account. Their name's on it, not yours. And I don't like that. We don't want to do that. You need to get a new merchant account. And then think of like your improvement plan. Generally, when you're purchasing a small business, you should have some angle on this of how you're going to improve the business. Are there new products you're going to offer, new pricing, new people you're going to bring into the business? Like, what is your strategy to grow the value of the business? Because that's what you're going to need to execute on next. So we know we got to focus on the people. There's all the technical logistical stuff that has to happen with entities, merchant account, bank account, getting the tax ID and all that. That's going to be necessary. So we're ready to go on day 1. And this should be going, by the way, is before you close. Like, you should be planning to just pull the trigger on this stuff, if not already have it done before you get into closing. Next thing is working capital. This is a big sticking point, is what working capital is going to be available to the new business owner. So if you purchase the business on, let's say, a Friday, what cash is available of working capital that you get? You know, what about the accounts receivable? Who gets that? The money of the business is owed. Does the seller get to collect the accounts receivable? That's typically common. The seller would collect their own accounts receivable. Maybe you've negotiated. You get to collect the accounts receivable because they have no working capital. So, but here's the bottom line is you need to have money to operate the business. You know, it's kind of like buying a new car. If you buy the new car, you expect there to be gas in it. You don't expect to buy the car, then you have to put gas in it. You expect to at least be able to drive it off the lot into your house and to work the next day. So, so we need a little bit of working capital in the business, because if you bought it on a Friday and let's say payrolls comes up next week, you barely own this business. Now you're going to be coming out of pocket again to fund the payroll or any unexpected costs, or any other things, just the regular expenses that are coming out in the business, the rent, the other expenses that might be common. So there should be some type of working capital that's maybe 1 to 3 months of expenses in the business that you want to have on hand. Now, if you've negotiated a bare bones purchase price where you're paying a very small purchase price, the seller might be reluctant to leave any working capital in. You might negotiate to collect their accounts receivable instead. If maybe your purchase price was even so low, the seller won't let you do that. Just be ready and know, I might need to throw some money in here for the first month or 2 to cover payroll or any of the regular expenses in the business before I can start relying on the cash flow to cover all the expenses. So, so just be ready for that and realize, I think sometimes, and I've seen this with some clients, is they love the deal. They love the deal making of purchasing a small business, and they they got too much caught up into that. They weren't ready on day one for when to run and operate the business. So let's just make sure that we are ready to actually go in and operate the business. Now, this was a down and dirty. We did this in about 40 minutes of kind of the main 4 components here: letter of intent, due diligence, asset purchase agreement and closing, and the things you need to think about to purchase a small business. I'm going to have a lot more info on this, on buying businesses. And also want to talk about selling a business. Many of you small business owners that we get the pleasure of working with every day, how do you position your business for sale? What do you need to be thinking about from the seller's perspective to prepare that business for sale, to get the maximum value out of that business that you spent decades, building and putting your blood, sweat, and tears into? All right. Do we have any live questions, or we have some questions teed up?
Yeah, definitely. We got a question from our fellow Matt. He says, several years ago, I bought a self-serve car wash. It was a dump, remodeled it. Now he's also a chemistry teacher during the day and lives in New Mexico. He's actively looking to buy a second, third, etc. Attempted to buy, but owners lack financials. How should he value these?
Ooh, attempted to buy, but owners lack financials. Okay. One thing you can do, and I actually like this, is get into their bank statements and their merchant accounts, because they are charging for their services, right? And they're also paying for their expenses. So like, this business is operating. So there's going to be a record here, and sometimes creating it from scratch benefits you as the buyer, because you get the real understanding of what this is. So what I would do is just break it down to its basics and just request 12 months of bank statements, request their merchant account statements. And then go request their payroll records. What is their lease? Like, they own the car wash, or they lease the space. And so then you basically are reconstructing what their expenses are. And since you've operated a car wash already, you will know the things that they should be paying for, like soap, or like, I've done some car wash deals before, and so there should be like, what is the expense for soap and all these things. And so you could just reconstruct the financials. So I actually like that, because then when you get to due diligence, you frankly don't need to do due diligence. You've already done it. You've constructed the financials to determine what the purchase price is. Also, I will say, because you are constructing the financials yourself, you are in somewhat of a position of power to determine what you think is cash flow to then apply a multiple to. So, some people might look at this as a problem and like, I don't want to buy this business. I actually like this, because I like being able to get into the numbers here and figuring out how that business is profitable. Now, sometimes there's things you just don't know. Okay, that maybe they're accepting cash for payments and that's not being tracked properly, and now you're just going to rely on the word of the seller. That's a little dangerous there. Maybe there's some expenses that you didn't think of, but I would think, since you've ran a car wash before, you're going to know on the expense side what they need to be paying for, and there's going to be a record of that. They are paying for it. So let's figure out what that is and try to get that record. And then just look to bank statements and merchant account records in terms of what the income is.
All right, we got another one from Cass. Where do I find businesses that are for sale? Is there a Craigslist or something?
There's not a Craigslist, but there's like bizbuysale.com. And if you just start looking around, there are a number of directories that have businesses for sale. What I would say too, if you have at least 100,000, either your own money or an investor, and you have decent credit where you could get an SBA loan, go get a business broker. Go get a business broker that will go shop business deals for you. I've had clients, many not use business brokers, many use them. And, they're like any professional. Some are great, some aren't. But a lot of business brokers have networks into what's for sale in that market. And they even have them by industry type as well, and purchase type price. And some of them have them on their websites too. So another thing you could do is just search all the business brokers in your area if you're trying to buy a small business in your area. And a lot of them list the businesses they have for sale on their business website. Now, there's a couple of groups that have business brokers on their site. One is the International Business Brokers Association, the IBBA. The reason I throw that out there is you can find the brokers in your area and then go to those brokers, and you can look up, a lot of them list the businesses that they have for sale. But if you go get that's also a good place to go look for a business broker if you want to get one. You don't have to use a business broker. A lot of people, if you're like in a particular industry and growing it, like the last person with the car wash question, you might know other car washes for sale. But I would spend some time in asking some business brokers, just have some conversations with them, see if it's a good fit for you. A lot of time their fee can get funded in the purchase price process. Some of them might have a retainer to get started or something like that. But that's a great place to find businesses for acquisition as well. And it's something that you can get on their list and on their radar. If a business does come up like this in this industry and this price point, they know you as a interested buyer.
Okay. This one's from Lauren L. Is it better to start a new business instead of acquiring one?
It depends. I'm actually looking to acquire some businesses right now, just myself. And even just in our IRA business, we've had a lot of companies that wanted to sell to us in our space. And I've been like, I think I can grow it faster than what you want. I can grow and get those accounts and that new customers that you already have faster than I could just buying them from you. And at a much better price too. So it depends, but I do think I've definitely seen a lot of clients have success with it. I've seen some clients fail at it too. One of the most disheartening was I had a client, and I'll just talk about a failure. He bought a pool service business. Okay. I don't know why he wanted to do that, but he was in his 50s and he kind of wanted to get out of corporate America, had a good career, got to a pretty high level, like a VP level in corporate America. Hardworking, smart guy. And he just wanted to be a small business owner and wanted to have his own schedule. So we thought, but a lot of people have this dream of entrepreneurism. Like, it's like, oh, you have control of your life and schedule. You actually have a lot less. And that's what he realized. He bought a pool service business and he realized he just bought himself a job. Like, he could make money, but he had to go service 200 pools a week, and like that was work, just because you got to own it doesn't make it any different. And so, so I think sometimes buying a business, you just have to look for the right business for you, like what is a business that's going to get you excited? And also, what is the right business that makes sense? Is this a business that's going to be growing? Is this a market that it's in that's growing? Is there a lot of competition in the local area for that type of business or not? And, but on the other hand, starting from scratch, it'll take you longer. That's the thing. Buying an existing business gives you a head start, right? If it's in the right category. But what I wouldn't do is just go buy a business in something you're not interested in, right? Most people aren't going to start a business in something they're not interested in, but you do see people buy businesses that they're not really interested in because they think it's a good deal or they couldn't find anything else. But if you're starting a business, you're typically going to start something you're passionate about or have interest or experience or background or something in. But sometimes I just see clients buying businesses that I'm like, why are you doing this? You have no background in this area. And do you love this type of business? So I don't know. It just depends. I think I'll just give another analogy to buying a home. Is it better to buy a new home or buy an existing home? It depends. What type of financing can you get? If you build a home, it's going to take longer. If an existing home, though, it might have more issues and it might not be exactly what you want. It's kind of like buying a business or starting a business.
Thank you, Matt. All right. This next one's from Michelle 312. What question should I be asking the seller when buying their businesses?
Ooh, good question. What question should I be asking a seller? Well, I want that list of due diligence, right? I want their financials. Probably the biggest question I want to get at, and this is more conversational. I want to know why they're really selling the business. A lot of sellers are kind of like cryptic about it. Oh, it's a health reason. Is it really? Is it really? They might be like, the health reason is, I'm just stressed out. This business is garbage. And, like, let's really understand why they're selling the business. And I think the best way to get that answer is not by asking that question, But just by having real conversation with people about them, about what success they've had in the business, what are they looking to do next? Like those types of questions, you'll understand why someone's really selling the business. And maybe it is they're just at retirement age and they're ready to just pass it on. Their kids don't want to take it over. There's no family around that's interested in it. There's no existing employee that wants to take it over. But I really like to understand, why are you selling the business? And if I can see, and frankly, that answer is really gonna help me, because if they're in a distress situation, that could be an advantage to me, right? It's just the same thing could be in the real estate market. A stressed seller, I got a little more better terms than I could otherwise get. But I also want to know what I'm getting into as well. There might be issues in the business. There might be a partnership dispute going on in the business. There might be a major customer that left them 6 months ago and the business hasn't really recovered, or they don't know how to go forward from there. We don't know what happens here. So having a good understanding of that will help you make good decisions about whether to purchase the business or not. So I probably think that's the most critical question, is understand why they're selling. Then the due diligence, of course. But try to get that question answered, but don't ask it, right? People aren't going to give you a straight answer, unfortunately, just asking it straightforward. Try to get to it through conversation about the successes they've had in the business, what they're looking to do next. Has your family been involved in the business? Have you had any partners in the business? What's been your biggest challenge in the business lately? Ask those types of questions to get to the answer.
All right. This is the last buying a business related question.
Okay.
Kyle T wants to know, what should I be checking for on the financial statements?
Okay, the two lines I go to immediately on a financial statement is the net income, cash flow. So if you're looking at a profit and loss, a P&L, that'll be down there, the net income. Sometimes there's a cash flow statement that might make it a little simpler. But I also want to then go look at the payroll. I want to look at how much employee cost is involved in the business. A lot of small businesses are not inventory heavy or equipment heavy. So generally your largest expense is going to be payroll. And so I want to understand what's in the payroll. I want to get the payroll detail. What are the employees paid? And I want to particularly know what the business owner is taking in terms of salary, because that, again, like I said, is going to affect the net income or the cash flow happening. Now, there's a couple other things you want to make sure you know about in the financials. For example, are they depreciating assets? Is this a C corporation that the company is paying corporate taxes? These are all things that actually are profit, but reduce the net income on the financials. So this is why people use EBITDA, earnings before interest, taxes, depreciation, amortization. It's a better show of what is really the cash flow of the business. It might not be the dollars and cents, of what's coming out of the business, but it's a better number than just like net income on an income statement or a P&L. And so knowing where the expenses are and what they are will also help you understand the value of the business. So like payroll, for example, that's going out, right? Like you don't get that money back. It's gone. You have that employee cost. Great. You've got the services and the labor, but that's gone. There's other things though, like let's say they bought a bunch of equipment in the business for $100,000. And let's say they depreciated the whole thing in year one. Well, that equipment I'm going to use next year and the next year and the next year. So $100,000 of depreciation in year one when they bought the equipment shows as $100,000 expense on the financials. Well, I might not actually credit $100,000 off in my own mind. That's great if they did on the financials. That helps me get to a lower net income number, which is a lower purchase price. But I might want to pay attention to that to know actually that wasn't an expense 100%. I shouldn't allocate that 100% onto year one because I'm going to use that equipment in the next few years. All right. Any other business purchase questions? Okay. All right, we did have some other questions come in. I'm going to hit those in a rapid fire here in the next 5 minutes, though.
Yeah, these are all just going to be...
Thanks to everyone for asking the business questions, buying a business. It's been a while since I've taught on this subject, but this is such a critical component, and I definitely want to get that content out here. And we'll be doing more, actually, on buying a business, and then I'm going to do another series on selling a business, too.
Awesome. Okay, so these are just both crypto related. These are both from the website. I want to buy crypto and I already own crypto. Would I need to sell my current crypto to get into a Roth IRA? A crypto Roth?
Okay, if you already own crypto, right now, personally, you cannot get that into your Roth IRA, unfortunately. All right. I know you'd like to, right? Take those gains you'd otherwise have, get them over to your Roth IRA, and then sell the crypto in your Roth IRA and pay no tax. But the government thought of that, and they knew that could be a way to avoid taxes, and they restricted you from transacting your personal assets over into your retirement account. So with a Roth, you can put $7,000 in for 2024. Actually, until April 15th, 2024, you can still do your 2023 contributions of $6,500. So you could be putting in $13,500 in an IRA or Roth IRA, depending on your income limits, of course. But once that money is in, then you could buy, let's say, $13,500 of new crypto in the Roth IRA. So where we have Directed IRA, our company we have over 100 million in crypto clients that invested in that. They're all purchasing that with new dollars. Most of those people already own crypto in their personal name. They've already been interested in investing in it. They've just realized, I actually prefer to do this in my Roth IRA where I pay no tax, but they're putting new dollars into their Roth IRA, or they're converting existing traditional IRA dollars or an old employer 401k into the Roth IRA, and they're buying new crypto with the Roth IRA.
All right. And this is going to be the last one. Let me try to decipher this question for you. The context is a little confusing here. So I already have around $60,000 worth of crypto. If I start a Roth IRA at 60 years old, I am in the low bracket and planning and saving for 10 years. What are my options?
Okay. So at age 60, when you say low bracket, I'm presuming lower income bracket. So trying to plan and save for retirement, and $60K in a Roth IRA.
Doesn't specify. All it says is I already have crypto around $60,000.
Okay. All right. Well, I think this is the hard part. At age 60, and we've come across so many clients over the years that just have not saved, and they haven't built their retirement accounts. Maybe they do have a business and they haven't sold it yet. That's another way to monetize and take care of your retirement is selling a business or real estate, of course. But I think at age 60, though, let me just try to break this down in different pieces. It still makes sense to save in a retirement account. You still have a 10-year window, as it indicates there in the question of maybe where they're still planning to work for another 10 years. So I still like the use of a retirement account, getting 10 years of growth. If you think of the rule of 72, we've talked about that before, but the rule of 72 says you can double it's a calculation on how you double your money. So if I'm getting an 8% return, I will double my money every 9 years. And an 8% return is very doable, just even in the stock market, let alone self-directing, doing real estate or small business stuff. But so you could double your money over that 10-year window through your contributions and what you're getting in. And then of course it continues to grow as you're in retirement. Even if you're pulling on the money in your 70s, the rest of it still stays invested and can continue to grow. So I just love that. I just think that's why I love retirement accounts, is because it's this forced method of saving, whether you're 60, 50, 40, 30, or 20, that money is set aside no matter what your investment horizon is, 10, 20, 30, 40 years. Now, yes, would I like to be doing this in your 20s or 30s? Of course I would. But we don't have a freaking DeLorean and plutonium and a time machine to go back in time to change that. So what can we do? Well, you've got a 10-year horizon. That's still better than nothing. And so I would still look at that as a tool to use. Now, crypto being in the mix there, you're in your 60s. You want to be careful how much you're allocating to crypto. I'm not a financial advisor. It's not meant to be financial advice here. You might want to get one. Just take that into account too as you're investing. I would just say with crypto is don't over allocate to that. Who knows where that's going to go? I definitely am a fan of it myself and I'm invested in it myself, but not over allocating to it, especially at age 60, would be really prudent advice, I think. All right. Well, thanks everybody for all the live questions. Everybody hanging in there on the buying a small business topic. Like I said, we'll be coming back with some more pieces on buying a business. Also looking at it from the seller side and selling a business for any of you business owners, things to consider there. And then make sure you're getting over to mattsorensen.com. There's an Ask Matt button there where you can ask your questions, where you can even record an audio version of the question. We'll play live here if they're applicable to the topics we're covering. You can also just type in your questions. I read some of those today. We covered some of those here at the end here that were people that submitted their questions at askmatt.com. And then, of course, we're back here every Monday at noon, getting into topics to help better take control of your financial future, building wealth, whether that's real estate, business ownership, asset protection, tax planning, legal planning, retirement accounts, all those amazing things. They all come together to help build our wealth for the future. So we'll see you back next time, Monday at noon. See you then.